Guys, so today we are discussing Binding Private Ruling 430, which deals with the distribution of a loan claim. Now, I always say this when we cover rulings, because I don't know who's joined last and who hasn't, but you guys will know the story by now. Rulings are only binding on SARS in relation to the applicant, right? So while SARS gives a ruling here of the tax treatment of this transaction, it's not like we can rely on it as binding authority. We nevertheless look at them because they do give us a general idea of how SARS is likely to look at a particular set of facts and how they interpret the law. And I have on occasion gone to SARS to say, listen, I read through these rulings and I'm pretty sure that my transaction looks very similar to the ruling that you've ruled on before. Can you rule the same for me as well? Now, I want to be careful with that sort of approach because the rulings are very much sanitized. Right? We don't know all the facts. We look at the final issued ruling versus what is published and the forms that we get, the ones that's publicly accessible, not very different. The conclusion is the same, but it's condensed into 3 pages when the actual ruling is like 15 pages long. Right? So that also brings me to interpretation constraints. When I discuss rulings, of course, we are constrained in terms of what we can deduce and draw from the ruling, but it is crucial that when we read rulings, because it can very easily read a ruling and go, so what? You know, that doesn't really mean anything. And it's true, if you don't question and ask what is it that these guys were trying to achieve and why they went for a ruling, then the rulings become pretty much useless, right? And I'll grant you that. For those who don't know me, I'm Niku. Right, this training is intended for myself. For those of you joining online, really just for your interest's sake. They couldn't. This is so small, but anyways, there it's big. I can look there. So, all right. So the transaction here involved an applicant South African discretionary trust with a resident natural person beneficiary, right? Who was also a beneficiary of a non-resident trust. So we've got the South African resident beneficiary, natural person who's a beneficiary of a South African trust and a foreign trust. And my apologies for those who work in restructures. Often I know trusts are supposed to be triangles, but I've ran out of time, so it's squares. All right? So, and this foreign trust obviously had some investments, right? So what happened in the past is the South African trust had advanced an interest-free loan to the South African natural person beneficiary, right? And the South African resident beneficiary used that money and advanced an interest-bearing loan to the foreign trust, right? Why interest-bearing? Because in Section 31, right? So this was the situation. It was money that was a loan that was advanced from South African trust to natural person beneficiary who on-lent it to the foreign trust. And of course, presumably because of Section 31 and presumably because of Section 7C, charged interest and accounted for the income tax on the 24J interest, right? So what they tried to do is they said, okay, no, hang on. This issue creates for me, or the way I see it, they don't say that in the ruling, but when I looked at this ruling, I thought, well, why are they doing this? Because what they're doing is they're netting off. Where's this slide that shows the net off, right? What they're doing is they're going to net off the 2 loans against each other. So the South African trust is going to distribute the loan receivable from the beneficiary, the South African resident beneficiary. It's going to distribute that to the non-resident trust, right? So now the non-resident trust has a loan claim and a loan payable against the natural person beneficiary. And the reason I understand why that was permissible is because the South African trust deed allowed that transaction to take place. It allowed that distribution to be made to the foreign trust on the basis that the South African resident beneficiary is also a beneficiary of the foreign trust. So the South African trust deed allowed for this weird distribution to happen because the foreign trust is not a beneficiary of the South African trust, but it makes this distribution to the foreign trust. Apparently that was permissible in terms of the trust deed. So now obviously what you have is you have a loan receivable and a loan payable, and what they do is they set the 2 off, right, against each other. And what happened? The loan receivable from the foreign trust is no longer, it doesn't exist anymore, which means I don't have to account for 7C, I don't have to account for Section 24J, don't have to account for Section 31. It seems to me, you know, when I read this, and so that's not what SARS ruled on, by the way. They don't rule on that. But the way I'll tell you what they ruled on now. But the way I looked at it is, why were they doing this transaction? What is the tax purpose? And the only purpose is the fact that there was an intermediary resident beneficiary making a loan to a connected foreigner triggered 31 and Section 7C, right? And if the trust deed, I think if the trust deed allowed for the loan to have gone to the foreign trust directly, they would have probably done it that way. But it seems like they inadvertently created a 24J and Section 7C problem. And so they said, well, let's do this distribution, right? And then set the two off, and then we don't have Section 31, and we don't have 24J, and we don't have 7C anymore, right? What SARS ruled on is they said that the distribution is a donation. So this is now the distribution of the loan claim that the South African trust held against the resident beneficiary, because that loan, that claim, that asset is what is distributed to the foreign trust. So it says that is a donation, settlement, or other disposition as contemplated in Section 7.8, right? By the way, these attribution rules seem to be coming up more and more in practice. We had a client here the other day who said to me he's got a 7.2 problem because he's been making donations to his wife, right? And so I was asking questions. But anyway, this is 7.8. This is where there's a donation, settlement, or other disposition to a non-resident. But they say that the 7.8 does not really apply because the amount wouldn't have constituted income, so the money that's generated wouldn't have constituted income had the trust been a resident, right? And paragraph 72, which is the CGT attribution rules, also don't apply, and the distribution is exempt from the notice tax because it's a distribution made in pursuance of a trust, which is the exemption 56(1)(L, right? So now, interestingly, I just want to see if it's on this slide. SARS specifically says that no view is expressed on the general anti-avoidance rules. What is, and funny enough, I just got an email from a person who is very familiar with the SARS ruling processes yesterday, who's also normally in attendance at these sessions, and said they couldn't make the session. What is the point of that this time? Because remember, when you look at the no rulings list in paragraph 80 and 81, 80 sub 1 and 80 sub 2, there's a list of things that SARS will not rule on, and the general anti-avoidance or specific anti-avoidance rules is not something SARS is allowed to rule on. What is Section 7.8 other than an anti-avoidance provision, a specific anti-avoidance provision? Yet here we've got a ruling on it. Now, I suppose one could interpret the no rulings list as saying, well, it doesn't say, it says SARS may not rule. So it gives them a discretion, as the argument, I suppose. Because what bugs me is, if you look at and I've always said this, whenever I discuss a ruling, you look at the Tax Administration Act, the purpose of rulings is to give certainty, though we can't rely on them, right? But one of the purposes of publishing advanced tax rulings and having the system available is to create certainty. Right, so now we've got a no rulings list that says you won't rule on anti-avoidance, specific or general, but then there's a ruling issued that rules on a specific anti-avoidance provision, which is 7.8 in this case. Right? They don't rule on 31 or 7C, which are also anti-avoidance provisions. That could be because the people who asked SARS to rule didn't ask for a ruling on those things, right? Which is fair, so that's not necessarily SARS' issue. They also didn't ask about whether or not this is a write-off of a debt, right? Which is the other things I'm considering. And maybe the reason for that is that's where SARS kind of either drew the line, so we won't rule on that, but we'll rule on 7.8. I don't know why. Maybe because they're comfortable 7.8 doesn't apply, right? But then, does that mean I can apply for a ruling to see if an anti-avoidance provision will apply or not? Yeah, so in my mind, this is not the first time that SARS has issued a ruling where I thought, hang on, but this seems to contradict, or on the face of it at least, seems to contradict what is on the no rulings list. You know, facts, for example, something that SARS won't rule on is something that's very factually intense. And then I think in their guide, the comprehensive guide to advanced tax rulings, they say they won't rule on something like, in that category, something that's too factually intense, like capital versus revenue. Right? But then a couple of weeks ago, we discussed a ruling where SARS ruled it's capital in nature, or whatever the case might be. And it's not like it was equity shares. I think it's 9C, you know. But anyway. It's for me concerning in the sense that it creates uncertainty. I'd be happy if I can go to SARS and ask for rulings on anti-avoidance provisions, right? And say, well, I don't think it applies, or if it does, do you agree that it has no consequence, which is what these guys got. It applies, but it has no consequence. Can we rule on that? And the question is, well, can we or can't we? And it's not like a ruling application, and this is important for the guys listening online that hasn't done ruling applications before. It's not like you can just go to SARS and ask them a question, It's a hell of a lot of work that goes into preparing a ruling application, right? Because the law says that you must set out the facts in the law and, argue your position that you want SARS to rule on. SARS isn't there to give advice; they're there to check whether whether they agree with your interpretation of the law or not. So it's unfortunate, and there's of course costs involved in preparing that, and there's costs involved in submitting an application to SARS. And I think it's 14,000 rand. I don't know if it's changed recently, but it's 14,000 rand once-off non-refundable application fee. All right, so it is unfortunate that we have this issue. It's also weird that they would make the statement in this ruling that they don't make any. Why do they say that no view is expressed on the application of the GAR? Is it because they think the GAR might apply? Because what is the purpose of this transaction? They don't say it in the ruling. I can see it. It's clear to me. It gets around. It not gets around. It deals with the 31 and the 7C issue to the extent there was a 7C. I don't know what the arm's length rate is, but these foreign loans, arm's length rate for foreign loans is hardly ever close to 7C official rates. It's normally quite low. And so that's why they made that amendment. I can't remember when, but they made an amendment a couple of years ago where they said that 7C is only excluded to the extent that there's an adjustment under Section 31. So if you had an interest-bearing loan that's arm's length at 1% or 2%, right, which is not far-fetched, actually, if you start looking at foreign interest rates, it's not far-fetched. Then people say, oh, goodness, thanks, 31 applies, so I can't get 7C. And they say, no, the difference then between the official rate and the 2%, that's 7C. And the timing of this transaction, it just seems like, and that's why this point, they don't rule on the general anti-avoidance rules is for me, why are you saying that, right? Because following ABSA, right, you could be falling in the GAR even if you didn't know about the transaction, right? At least so the interpretation goes. Right, so that's the point. The ruling for me, all it says, it's 7.8 does apply, but there's no consequence, and it's exempt from the nation's tax. That's the only thing they say. Right? Now, if you look at that and you read only that into the ruling, you'll go, N? Why are we covering this? Right? So for me, the reason we're covering this is because, one, it shows an interesting way to deal with the 7C problem and a Section 31 problem, but then there's the caveat to say, be careful. We think the GAR might apply. Okay.